What's good, superstars? Back with another living out of my brokerage account video. Today, I'm going to give you an update on the portfolio, update on everything that's been going on in the new year. Happy New Year. It's 2026. This is going to be the first full year of playing around with this strategy. Been really liking it so far. Started out in September. Not fully living out of the brokerage just yet, but on my way there. Been increasing the amount of bills I've been taking out on a monthly basis. This month I think I'm going to increase it again, just to see what's sustainable. But yeah, so far so good. I'm going to go show you guys everything. It's going to be a pretty fun video. So first I want to show you guys my cash flow chart. For any of you guys who are new to the channel, please hit the subscribe button. Hit the subscribe button. I'm making this video in my car. I'm showing you guys my journey here, and I mean, I want to keep posting. I want the motivation. You guys subscribing really helped me be motivated. But anyway, what happens? I get paid. A portion of my paycheck is deposited. I don't deposit my entire paycheck just yet, so I deposit that into my brokerage account. I invest 60% of what I deposit into a margin account, which is invested in mostly growth stocks, ETFs, and then 40% goes into my TFSA, which is a tax-free savings account here in Canada. And I have my higher yielders, basically 10+% yielders in that account, because obviously long-term goal is to live off of the distributions, and if they're tax-free, it's even better. In the long run, distributions every single month. So if I get paid $200 in that month, that $200 at the end of the month, I reinvest it into the TFSA, buy some more high yield funds to help snowball. As the dividends grow, I'll be buying more, and it's just going to snowball and snowball, and this account should get bigger. In the meantime, my growth account and my margin account, this is kind of where I'm living out of. I'm using the margin to pay off my bills. And the margin account in Canada and my Wealth Simple account allows me to link it to my TFSA account, meaning that my collateral can be the combined total between the two. So it's a nice little system I got here. So the 60% goes into the growth account. So as money grows in the margin account, if I have money that's, let's say that my margin is way above the 50% equity goal that I have. Let's say we're at like 65%. I might use some of that money to buy some put credit spreads, which is an option strategy. I've talked about it a little bit. There's a video, maybe I'll post that at the beginning in the top right of the corner. You can click that, go back to the beginning and click the I at the top right corner of the video. But yeah, that'll help fund, because that'll give me premiums, and those premiums can be reinvested into margin, and we can go from there. Or I can just keep using those premiums to buy more put credit, or sell more put credit spreads, get more premium, and snowball that way. Just growing the amount of money in the margin account, which will give me more margin, which will allow me to pay more bills, because it will keep my equity higher. Any other deposits I get in the year, if I get paid extra money for whatever, if I come across a couple $100, someone gives me money for my birthday, that money will go into the margin account and it will pay down margin. I have a video explaining why extra money, I use it to pay down margin rather than invest, because of the way that it affects my equity. So any extra money that's not part of the system is going to go in just to pay down margin. The more margin I pay down, the more available that I can use to pay down bills. Paying bills. Since I said I'm taking the money from the margin to pay bills, 70 to 100% of the money that I deposit will be used to pay bills. Right now, early on, I need to have a spread. Unless it's 50-50, where I put 50% into equities and 50% to pay margin. So let's say I invest 100%, I only take out 50%. That's when my equity will stay the same. Anything above that, I'm going to see a drop in equity, unless there's growth of the account, which will make the equity go up as well. Or I'm investing more money from other deposits, or I'm getting premiums from put credit spreads. So these two items here should help keep my equity higher as well, which will help me sometimes have above 70% or above 50%, which will keep my equity stable. So that is the meat and potatoes of the strategy. I'm going to keep talking about it because it's a difficult strategy, and I know even if you've seen it once, you haven't seen it enough. You have to see it like 5, 6, 7, 8 times to really understand why I'm doing what I'm doing and how I'm doing what I'm doing. So just explaining my process. So now let's get into the accounts. This is my breakdown at the top. Spreadsheet is very complicated. People want me to share the spreadsheet. I gotta really fine tune it. I've been changing things here and there, trying to really perfect the system. So until that time, I'm not going to share it. You guys can see what you see here and kind of make your own spreadsheet for now. But eventually I will come up with something once I get into the rhythm. I've only been doing this for 4 months, okay? So bear with me. But anyway, These are the holdings I got in the growth account. I'm not going to go through every single one. The ones that are in red font are Canadian funds. The ones in black font are American. The ones green are positive in return, and the ones in red are negative in return, not including dividends. Overall, the margin account, or the margin growth account, is up 8%. Income account, not so much. The TFSA, we were hoping that this would stay even. Maybe with the redistributions, it has been staying even. I got to double check that number, but at the same time, look at all the red. It's a sea of red. These high yielding ETFs are not holding their weight everywhere. What I have done though is I've started to double and triple down into the winners, which has helped me maintain this percentage. I think I've been around 10-11% for the last 2-3 months. November was a really big drop off for this account, so the fact that it's maintaining itself and staying stable, the more money I put in, and plus this margin account is going up, we're starting to see a rebound. This was in the 1,200-1,300 range before. Now we're only 500 down overall on our book value, which is not bad. The equity is 53%. I just have a little mini withdraw. So if I take out $300, this is what my new equity would be. I have that there just in case if I'm ever need to take out money to pay a bill, I can run it by and check and make sure that the equity will stay above 50%. If it goes below 50%, again, not the end of the world. I have a pretty high risk tolerance, and I know the end goal. I know that the stuff in my growth account is pretty stable stuff in the long run, like in the history. Hopefully moving forward, it maintains that, but that's it. I'm investing in a ton of stuff. So 2026, I wanted to tell you guys, I'm going to be changing things up a little bit in the income side. I might be getting rid of a few funds. I'm not going to get rid of a bunch of funds. Like I said, I would never sell things. My growth account, I'm never selling. So this is only going to get higher in terms of number of holdings, if anything. When it comes to the stuff that's in here, it will never be sold. I will never take a taxable loss or a taxable gain on any of these items. These are all in it for the long run. They're all contributing to my margin availability. They're, for the most part, they're pretty stable. My physical gold actually needs 100% margin maintenance, but I now have 500 book in there, so I'm happy with that. And I'm starting to split it up. Like I might be adding a few more different precious metals, or maybe like a basket of precious metals. I really like that commodity sector right now. Even though it's all-time highs, I just want to have it as part of my portfolio, so I'm building that out. And you can see my percentages here and my goals. I originally started where I was doing 40-60 the other way, 60% high yield, 40% growth. I said, no, I'm at the beginning of this. I'm trying to grow my margin availability. I need to do more into growth, a little bit less into high yield. Down the line, I can always change it. I can go 70-30. I can go 30-70. It will depend on the time and where I'm at. But right now, this seems to be working for me. The numbers are starting to come down on the high yield, and the numbers are starting to come up on the growth. Eventually, we'll get to our gold numbers, I think. But we're going to keep doing it like that. So that is the portfolio. You can see it quickly. I'm not running any insurance right now. I just don't. I started it, watched a couple people on YouTube, and I get it. I get the insurance buying puts on the market, but I've noticed that over time, if the market does decline gradually, those puts are not really doing anything for me. It's when there's a flash crash, like a 1-2 day, 10-20% decrease, that it will help absorb some of that cushion. At the same time, I'm also losing X amount of premium. Right now, my account's small. I'm losing X amount of premium over X amount of months. That if I take that into account, really, am I back to square one? What's the difference? So I feel like I just don't do it. At the end, if the market does tank, maybe put a little bit more money into like the triple leveraged UPRO or TQQQ, and hope to recover some of it that way. I don't understand it's time in the market, but at the same time, like it would be kind of obvious, I feel like, when the time is right for that stuff. That is so that's the case for that. I'm not really running any insurance right now. I do have a couple different ideas though, and put credit spreads is one of them. I'm really loving the put credit spreads. This is my put credit spreads that I've done. I closed the position. I had an ARM position open that was supposed to close on January 9th. It was like $12 to close it, so I just did that, and the result is 127 USD that I maintained from my 139. I guess I call it a reward, but really it's premium. And then I found that Pepsi had a pretty big downturn, so the current price is 138.96. I ended up buying a spread of 134 to 139. So right now I'm not taking home the maximum. If you look at this chart here, basically this would be my 139. This will be my 134. Anything that goes below that first strike price will start to decay my premium, which was 134. I did two of them. I did two options this time, so my risk is really 1,000, and then if it were to go to the max loss, it will be 1,000 minus the 134, so 866 is my max loss. We'll see what happens. It's closing on Friday, January 9th. Pepsi's a pretty stable stock. Hopefully we get a couple green days in here and helps me. If not, I'd have to find out my break even. It's probably going to be somewhere in the middle there, between like maybe 135 and a half, 136 will be the break even. So as we get closer to there, if I close it, then I should be pretty close to even, but we'll see. Anyway, that will be near the last day, right? Because the time decay on such a short turnover is a big deal. So we'll see what happens with that. But yeah, that's my put credit spreads. Just been experimenting with that. Dividend calendar, I haven't updated January yet, just getting back into it. Took a couple of days off of updating the spreadsheet, but you can see the dividends slowly increasing. Obviously the first month not too much, second month 287, third month a little lower, but we're redistributing. We did the switch from 60 to 40, and then this month was a little bit better at $306. We are investing a little bit more stable core positions in the high yield TFSA. They might pay between 10 to 20% rather than 20 plus. So we are going to see a decay in the 30%. This is basically, it's summarizing everything divided by the book value to give me my percentage, which is around 29%. Then I multiply that by 85%. Even though I got Canadian funds in there, I'm still taking away 15% when I account for what the rate was. So now I'm just going to say 30% because last month it ended up being 35.21 on my book. This money is what I made from the dividends. I have not yet reinvested it, so I have it in orange. I have to reinvest it this week. I'm going to find a few, maybe one or two funds, and put it back into the high yield and boost this number and take down the cash amount. So this number will stay the same, or well, the overall portfolio value of the TFSA, because some is cash and some is not, will be the same, but my actual investing will be higher. So that's that. Equity, we're around 52% last month. Now we're at 53. We're into this month, so I can actually highlight this in green, which is January 2026. And the hope is to get some increase in the margin side. Maybe we'll flip-flop it. You can see it's looking like the next 2 months are going to get past that. I think it's going to be this month, but we'll double check. Right now, I'm assuming my first investment, I'm hoping to do 3,000 this month. I did 2,000 last month, hoping 3,000 this month, which means that around 70% will be whatever this is, 525 times 4. So that will be like 2,100 will be into the account out of the 3,000. I'm hoping to maintain an expense float of 70%. Last month, I ended up actually putting a little bit more towards one of my lines of credit, just because I had extra money to get me to that 70% there. I think these will all be a little bit higher, but we're guesstimating very, very conservatively. So you guys can see here, we're in month 5. The margin account should grow a little bit faster because I did that switch with the percentages. So you can see it start to overtake it. If you look at a projection, I'm saying that it's going to grow at a 7% clip. It might grow faster, might not grow at all. I do have this account staying not decaying, which has not been the case overall. Obviously, I showed you guys we're down 11% from book, but luckily that was all early on, and some of the newer stuff's been holding up in the near term. So we have seen some growth from, obviously we've put in money and that's helped, but I think we're going to start to see the interest is around $33 on $9,000. It's not too bad. The interest rate is 4.45% right now. And the monthly float, last month, like I said, 2,000, and I floated 1,400. And the dividends was around 35% of my book on my TFSA. So that is the portfolio update. You can see here I have 2,000 going forward, just to see what it does to my equity. The equity eventually does come back up, or it's like 45% doesn't really stress me too much, but I do think that these numbers will grow quicker and kind of eclipse that. We're going to have to maintain it. We're going to have to see what's going on and how it plays out. That's the thing with this type of account. Very, very, you have to babysit it, and you have to make sure that everything is going out. That equity number, that's why it's in a different color. I'm always paying attention to this equity number. Right now, 53% is pretty healthy for my liking. and we're going to keep going. We're going to keep putting money in. The more money we put in and the less money we take out will help the equity. Any extra money that we get that goes in helps pay down the margin, helps the equity, and the put credit spreads, if we can maintain the premiums, are going to help the equity. So we're going to continue playing the game, and hopefully everything works out. Guys, I hope you're enjoying this. I hope you guys are liking this series. I mean, it's been a lot of fun continuing it 4 months in, and I feel like we're making progress. We are making some serious progress, and we're figuring it out together, what I like and what works and what doesn't work. And we're going to double and triple down on the things that work, and we're going to kind of stay away from the things that don't work. The only thing that's staying true is I will not be taking anything. I will not be selling anything in the margin or growth account. That is a taxable account. I will not be selling anything there. In the TFSA, I might be rejigging things. So when I do make some moves in there, which might be the next video on this series, which might be next week, I might show you guys a couple of moves that I did. Maybe I'll shrink it up a bit and focus on certain things. But any changes I make, I'm going to let you guys know for sure. Follow me on Blossom. Links are in the description. You can use my affiliates for Wealthsimple if you want to be on a Wealthsimple account. I'm all the details are below. Snowball Analytics, that's another one I could be showing off as well to see how I'm doing with the markets. Maybe we'll do that on the next video as well. But guys, I hope you enjoyed this. Again, I'm not a financial advisor. This content is for entertainment purposes only. I don't know what I'm doing. I'm filming it in my car. Guys, we'll see you in the next one. I love you. Bye.